This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 84 was recorded on December 16th, 2019. I'm Eric Townsend. GavCal co-founder Louis-Vincent Gave is back with us today, and this episode of Macro Voices is brought to you by TopTradersUnplugged.com, which happens to be my favorite podcast when it comes to quant and rules-based investing. Check them out. You'll be glad you did. Louis, on the Monday afternoon that we're speaking, the S&P is once again trading at record all-time highs, above 3,200 now. What's going on here? Is the driver for this the trade negotiations, or is it about the Fed and what they're doing with QE, or is it something else? And how do you see this market?
Well, first of all, thanks again for having me, and Merry Christmas to everyone, because I guess this will be released pretty close to Christmas. So it's a real pleasure to be back. And yes, we are having a nice Christmas rally. And I think, look, part of the driver is what you and I discussed in previous weeks, right? Is everywhere you care to look around the world, you get joint fiscal and monetary policy stimulus. So yes, you just mentioned the Fed's QE. For the first time ever, we now have the Fed doing QE at the same time as the BOJ and the ECB. We also have the Fed doing QE at a time when the U.S. is no longer fiscal tightening, which is what they did when the Tea Party was in power the last time around you had QE. But instead, you're getting big budget deficits in the U.S. So basically, and it's not just the U.S., the same is true in Europe, the same is true in Japan, the same is true in most emerging markets. Anywhere you care to look outside of China, today, you're getting monetary and fiscal policy expansion. And with that, I think you're seeing growth stocks rally, you're seeing value stocks rally, you're seeing international stocks rally. And so I think there's a number of factors. Having said that, if we go dig in the weeds a little more, I think what's interesting is that, once again, the S&P 500 has outperformed pretty much every equity index out there. In fact, going one step further, the S&P 500 has outperformed pretty much any equity out there. If you look at the S&P 500 as a stock, it's actually outperformed 78% of all globally quoted equities, which is, simply unprecedented. And the reason for that is pretty simple is, the big tech names have had a rip-roaring year. You look at Apple. Apple, by the way, is now bigger than the entire energy sector within the S&P 500. Apple's 4.3% of the S&P 500. The energy sector is 4.2%. So Apple's up 74.5% this year. Microsoft is up 55%. Facebook's up 48%. Google's up 30%. So in essence, in a year where Apple, which is already, which is now 4.3% of the S&P 500, in a year where Apple goes up 75%, basically either you were overweight Apple and you could have a decent year. If you weren't, it makes things very complicated. So, you look at the outperformance of these big tech stocks and brings you to now a level where your top 5 companies in the S&P 500 are 16.5% of the S&P 500. That's basically the same level that you reached at the top in December 99, at the top of the TMT bubble. And, you look at this concentration of performance, and I think, you think, okay, there's only 2 possibilities here. The fact that, the S&P 500 is outperforming 78% of all listed equities tells you that either A, we're moving to a world where basically all that matters is being big, and we're moving to a world with, more and more monopoly, and it's a winner-take-all world. That's option one. And so these quasi-monopolies like Facebook, like Google, like Microsoft are being handsomely rewarded by the market, option one. Option two, it's actually not so much about what the companies themselves are doing, but about what investors are doing. That, basically all the flows are now simply just going into the S&P 500, that it's being traded like a stock by most investors who decide, I need equity exposure, I'm just going to index. And so all the flows go into the index, and that makes the biggest stocks go up disproportionately. And, this, if it's the latter, it's obviously not a very healthy development. If it's the former, it's also not a very healthy development. Obviously, a world where you move towards more and more monopolies, there the risk becomes that there starts a political backlash because people and especially politicians don't like powerful monopolies. They're very jealous of their own powers, and to have companies that are too powerful is always a threat to politicians. So that could be something to look out for in 2020. It's definitely a running theme in the Democratic campaign, and that could be something that perhaps gives the market pause next year.
Louis, it's absolutely fascinating to me that more important, at least if you measure importance by market capitalization, more important than the entire energy industry, which provides petroleum that allows transportation and heavy equipment and vehicles and everything else. What's more valuable than that entire industry is a company that makes phones with 3 cameras on them instead of just one. I guess what I don't understand here is you would think, since Apple sells a lot of their stuff to China and does a huge amount of their business is dependent upon outsourcing manufacturing to China, you'd think, okay, who's going to be hit hardest by the trade war? It's got to be Apple because they've got so much exposure. They're up 77% on the year. How is that even possible? What's going on here?
Well, to be honest, not only would you think, but I not only did think that, I also wrote it. I wrote about that in my book, Clash of Empires. And, a year ago, I genuinely felt that Apple was, very much a potential victim of the unfolding trade war. Like you point out, it sells roughly 30% of its sales come from China. And then, indeed, it produces so much stuff there that, as the trade war evolved from being about trade and increasingly about tech, one of my fears was that Apple would be caught in the crossfire. But here, kudos first of all to Tim Cook, who's managed to navigate these choppy waters very well. So, I think that the management, he's managed to, stay on board with the Trump administration while at the same time managing any potential blowback in China. So far, Apple's done, again, a great job there. But to your point, as you look at the evolving U.S.-China relationship, what's pretty clear is that the first phase of the battle, which was really surrounding trade, may be, I think, getting resolved in the coming weeks and months. And that is because both sides have an incentive to basically move past trade. On the Chinese side, China is dealing with 4.5% inflation rate right now, all linked to food. So there's an obvious incentive for China to import large amounts of food from the U.S., which plays well for Donald Trump. With 4.5% inflation, there's also an incentive for China to actually let the renminbi move up, which is also something President Trump would like to see because that gives him a good talking point in his appeal to Midwestern manufacturing workers. So, there's a lot of politically alignment today to get something done on the trade front. Nonetheless, the question mark, we started with a trade war. It evolved into a technology war. The trade war may be getting resolved. The technology bit is moving full steam ahead. And here, the battlefields may have changed. The U.S. is now putting a lot of pressure on Europe to basically ban Huawei as well. And Europe, as it tends to do when the U.S. puts enough pressure, is falling into line. So the bottom line is, the technology battle will continue. And personally speaking, I think there is still a danger in owning the names that basically shadow the U.S. and China technologically. The long-term picture, I think, still is one where technologically each zone will have their own supply chains and there will be fairly limited connectivity between the U.S. supply chain and the Chinese supply chain. So, I was completely wrong on Apple this year, but I do think the technology war remains a very real threat for companies like Apple that straddle both China and the U.S.
With all of this momentum we've seen, where does that leave you? Are you ready to short a stock like Apple, or is it more of a keep a close eye on it and wait for it to break?
No. I definitely don't think you'd short it. Look, today we're back into massive liquidity injections all around the world. You're back to most likely global growth reaccelerating over the coming quarters. I tend to like cyclicals better. I like financials better. I like energy better. I like international stocks more than I like the U.S. because, as you and I have discussed, I'm a U.S. dollar bear. And everything that's unfolding now with, more and more and bigger Fed liquidity injections to ensure that the U.S. financial markets stay on tracks makes me an even bigger U.S. dollar bear. So I think that, the big opportunities lie elsewhere from big U.S. tech at this juncture. Having said that, no, this is an environment, I think, where I'd short anything except U.S. government bonds, to be honest, or actually government bonds pretty much anywhere around the world. We're now in an environment where policymakers are, pedal to the metal almost everywhere. I think this is a tough environment to short anything.
Louis, you mentioned the bond market. Obviously, the arch enemy of the bond market is inflation, which has been completely a non-issue for the last several years. But quite a few people I've talked to, Keith McCullough from Hedgeye and Charlie McElligott from Nomura, have been talking about inflation indicators starting to tick up, and that's the next thing that they see on the macro horizon. How does that view jibe with what you're seeing?
Well, look, I've personally been writing about inflation as well for the past 6 months or so. I look at core CPI, it's at a decade high in the U.S. I look at median CPI, it's at 3%. It's a 12-year high in the U.S. This is the first time in my career where I see the Fed not only cut interest rates but embrace QE at a time when not only is the unemployment rate in the U.S. at all-time lows, but it's also at all-time lows in Japan, in Germany, in the U.K. You've got asset prices, whether you look at corporate bonds, equities, real estate at all-time highs. You've got, unit labor costs in the U.S. going up, even though the U.S. dollar has been strong, which is, somewhat unusual. And even though oil prices have been, fairly tame, which is fairly unusual to see unit labor costs go up in that environment. So no, I agree with Charlie and I agree with Keith. I think there's a lot of indicators out there pointing towards higher inflation. And, when it comes to the U.S., today you've got core CPI and median CPI, as I mentioned, at decade highs. And this in spite of weak energy prices, and this in spite of a strong dollar. What happens if the story in 2020 is one where energy prices creep higher and one where the U.S. dollar heads lower, which is, my base case? Then, core CPI and median CPI will continue to go up. Having said that, I think that central banks all over the world have made it pretty clear that they definitely don't plan to step ahead of this trend. So, I think inflation will run hot. It will run ahead of expectations, and central banks will pretty much do nothing about it. So, in this environment, we can probably expect much, much steeper yield curves in 2020. That's one of the main reasons I'm fairly bullish on financials.
Louis, having touched on inflation, I want to come back to your view on gold. Last time we spoke, you thought that maybe it was time to start buying, and I don't think we've moved a whole lot lower since then. As we're speaking today, we're just flirting with the top channel resistance line. Does that mean it's time to watch for a breakout here, or you think we still got lower to go before gold bottoms?
Look, I don't think we're heading much lower on gold, no. The way I look at gold is I've historically always thought of gold as a sort of low beta ways to play emerging markets, partly because the marginal buyer of gold tends to be either in China, on the Indian subcontinent, or in the Middle East. So when emerging markets do well, gold tends to do well, and vice versa. And, emerging markets have been complete dogs for the past, 7, 8, 9 years. But they seem to be forming a bottom. Everywhere across emerging markets, you're seeing, again, outside of China, you're seeing significant interest rate cuts, you're seeing tax cuts, you're seeing some interesting regulatory reforms in countries like Brazil or India or Indonesia. So, all this points me towards an environment that's actually quite optimistic for emerging markets. And so, if you're optimistic in emerging markets, you got to be optimistic on gold. If you're bearish on the dollar, like I am, you've got to be optimistic on gold. And then finally, I think there's something, changing in gold today, which is that the marginal sellers are disappearing. For years, the marginal sellers were the gold miners, because that's their job, and the central banks. The central banks are no longer sellers, they're now buyers. And then if you look at the gold miners, you're seeing unprecedented consolidation. I think this year you've had something like $35 billion of M&A in the gold mining sector, which is a record. So, instead of digging new mines, they're basically taking each other out. which to me reminds me of what we saw in energy at the beginning of the century when, you had BP, Amoco, you had ExxonMobil, you had Phillips, ConocoPhillips. When all these guys start taking each other over, it's usually a sign of a bottoming commodity cycle. When they'd rather use their capital to take out the competition and dig new holes, that's usually a good sign.
Well, Louis, I can't thank you enough for another terrific interview. We look forward to getting you back in another month or so for another update. This episode of Macro Voices All-Stars was made possible by TopTradersUnplugged.com, my favorite podcast when it comes to quant and rules-based investing. And remember to head over and listen to my conversation with its host, Niels Kastrup-Larsen, which we released on September 7th, 2019. To get the slide deck that Niels shared, head over to TopTradersUnplugged.com/macro slides. And as a listener of my show, you're also able to get Niels' latest book for free by going to TopTradersUnplugged.com/macro. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.